Hey guys, welcome back to the channel. Are you one of those traders who is tired of placing stop losses that get triggered again and again only to see the price move in the exact same way that you wanted it to move? It's quite frustrating actually. I have already talked about the concept of placing a logical stop loss for your trades. It is a very good video to start with if you have no idea how to place stop losses for different trading scenarios. One thing that I missed on that video was the concept and application of a stop loss specialist. Yes, it's none other than the ATR indicator. I have made a video on ATR a long time ago, but it was not a very comprehensive video. So I thought, why not make a detailed video on the basic concepts and applications of the ATR indicator. These are going to be the topics that we will be discussing in this video. We will start from the basics of ATR, including the guiding principles of ATR indicator to its calculation, the shortcomings of ATR, and a few observations, and finally we will go in depth into the applications or uses of ATR. So watch the video till the end to get the maximum juice out of this video. Also make sure to like and share this video, and if you haven't subscribed to the channel yet, please make sure to subscribe and also enable the bell icon so that you won't miss out on any upcoming videos. So without wasting any time, let's get started. Let's start from the very basics. What is ATR? The average true range, or ATR, is an indicator that measures volatility in the markets. It was developed by J. Wilder, who is undoubtedly one of the biggest contributors to technical analysis, and he mentioned about ATR in his book New Concepts in Technical Analysis Systems, which was published in 1978. Unlike indicators like Bollinger Bands or moving averages, the ATR is usually plotted below the price rather than on or over the price. The ATR indicator talks about the market volatility only and nothing more than that. It does not indicate the direction of the trend or the momentum, but just the volatility. And why do you have to care about market volatility in the first place? To put it simply, volatility is a measure of price fluctuations in the market. If there is high volatility, then price swings happens very quickly and unpredictably, resulting in high risk, high reward trading conditions, and while during low volatility conditions, the price swings are more calm and relaxed, so both the risk and reward drops significantly. But the real reason why you need to be bothered about volatility is due to targets and stop losses. Let me explain. Do you think a tighter stop loss would work in a highly volatile market condition? And similarly, do you think a very wide target is likely to get achieved in a low volatile market? The possibility of them working in the favor of your trade is very dim. This is where the ATR indicator comes into picture. We will talk about all this stuff as we move further forward in this video. But for now, let's look at how the ATR indicator is calculated. This is an important step because it gives you clarity as to how the indicator functions and why it will work in real market condition. And this is also one of those things that I need you to be cautious about, since there are a hell lot of indicators flying around these days giving out buy and sell signals, but nobody shares the logic behind them even if you pay for them. So always make sure that you know what the basic idea behind the indicator is before you use them, right? Let's look at the calculations now. How are ATR values calculated? Well, it can be done using one of the three methods depending on how the candles are formed. To calculate the average true range, the first step is to calculate the true range or TR. For doing this, the current price bar is compared either to itself or to the previous bar's close price, and the true range is taken as the greatest of the following calculations. So here's how you should do it. The first method is to subtract the current candle's low price from the current candle's high price. The second method is to find the absolute value of the difference between the current bar's high and the previous candle's close price. And finally, the third method is to find the absolute value of the difference between the current bar's low price and the previous candle's close price. And as I have mentioned, the true range will be the maximum of these three values. Now, there is a reason why we use absolute values in methods 2 and 3. It is just to ensure that the final result is a positive number. After all, Mr. Wilder was only interested in measuring the distance between the 2 points and not really the direction. So if the current period's high is above the prior period's high and its low is below the prior period's low, then the current period's high-low range will be used as the true range. This is referred to as an outside day that would use method 1 to calculate the true range. This is a pretty straightforward method. Now methods 2 and 3 are used either when there is a gap or an inside day, where the high and low range of the current period candle is within the previous candle's highs and lows. So if a gap occurs when the previous close is greater than the current high, it signals a potential gap down, or when the previous close is lower than the current low, it signals a potential gap up. So you can learn more about gaps and how to trade them in my price action playlist. Now let us understand these three methods with examples. So in the first example, the current candle's range is larger than the previous candle, which means an outside candle is formed. So we will use method 1, that is to find the difference between the current candle's highs and lows. Now in the second example, you can see a small higher low range formed after a gap up. In this case, the true range will equal to the absolute value of the difference between the current high and the previous close. And in the third example, there is a small higher low range formed after a gap down. In this scenario, the true range is equal to the absolute value of the difference between the current low and the previous close. Now let's consider a final example to understand things better. Look at this. Even though the current close price is within the previous higher low range, the current higher low range is quite small. In fact, it is smaller than the absolute value of the difference between the current high and the previous candle close, which is quite obviously the true range. Now, typically, the average true range is based on 14 periods and can be calculated on an intraday, daily, weekly or monthly basis. But by default, most charting platforms use a 14-period ATR. For this example, the ATR will be based on daily time frames. Let us take a look at the general method for finding ATR first. Since there must be a starting value, the first true range value is simply the high minus the low of the first candle under consideration. Once the true range is computed for the desired period, the ATR can be calculated as the average of the true ranges over the past n periods under consideration. Now the formula that is used to calculate the current period ATR is given by current period ATR is equal to previous period ATR multiplied by n-1 plus current period true range, the whole divided by n. So for instance, in case of a 14-period ATR, n will be equal to 14 and n-1 will be equal to 13. While in case of a 7-period ATR, n will be equal to 7 and n-1 will be equal to 6. The first 14-day ATR is the simple average of the daily true range values for the past 14 days. From the next period onwards, each current period ATR is smoothed by incorporating the previous period's ATR value. Or simply, in case of 14 periods, the current ATR is equal to prior ATR multiplied by 13 plus current true range, the whole divided by 14. This simply means that you have to multiply the previous 14-day ATR by 13, then add the most recent day's true range value, and then finally divide the total by 14. So what are the key takeaways from these calculations? First point, the larger the range of the candles, the greater the ATR value, and the smaller the candle's range, the smaller the ATR value. Second observation, as the volatility expands, the ATR indicator would point higher, because when you look at the range of candles, they are increasing over time because volatility is associated with large price swings and candles. So basically, the larger the range of the candles, the larger the ATR value is going to be. Now, let me talk about a few mistakes that traders are likely to make when dealing with the ATR, or maybe let's talk about a few drawbacks of ATR. First of all, ATR is not a trending indicator. A rather common mistake that traders make while using ATR is assuming that the volatility and trend go in the same direction. But this is not right. Recall the fact that average true range indicator measures the volatility of the market. This means volatility can be low while the market is trending higher, and it can be the other way around. So the thing that I want to point out is that ATR indicator does not tell you the direction of the trend. This is not a trend indicator that tells you whether the trend is going to go up or down. So let's take a look at a case where the market is clearly going higher, but the ATR value here is going lower. So as I have clearly stated just now, the ATR indicator measures volatility in the market. It only looks at the range of the candles. In this case, you can see the range of the candles is getting smaller, And that is exactly the reason why the ATR indicator values are decreasing. So don't presume that if ATR line is rising, it means the price must be in an uptrend. It's not necessarily true because the price could either be in an uptrend or in a downtrend. So to identify trend, either look into price action or use other trend-based technical indicators. What the ATR tells us is that if ATR line is rising, volatility is increasing, and if ATR line is falling, volatility is decreasing. Now the second drawback is that ATR values of different stocks or indices cannot be compared. Now ATR is based on the true range, which uses absolute price changes. As such, ATR reflects volatility as an absolute level, or in other words, ATR is not shown as a percentage of the current close price. This means low price stocks will have lower ATR values than high price stocks or indices. For example, Reliance stock has an intraday ATR value ranging between 25 to 85, while Tata Motors stock have a much lower ATR value between 5 to 25, while index like Bank Nifty have a much higher ATR value ranging anywhere between 400 to 1500. So because of this, ATR values of different assets cannot be compared. Now let me talk about a few observations of ATR indicator. First of all, ATR is not a directional indicator like MACD or RSI, but rather a volatility indicator that reflects the degree of interest or disinterest in a price move. Strong price moves in either direction are often accompanied by large true range values due to long-ranged candles. This is especially true at the beginning of a price move. On the contrary, weak price moves, as you may have already guessed, are accompanied by relatively narrow ranges. So as such, ATR can be used to validate enthusiasm or interest behind a price move or a breakout or a reversal. For example, a bullish reversal with an increase in ATR values would show strong buying pressure and it will reinforce the reversal. Similarly, a bearish support level breakdown with an increase in ATR would show strong selling pressure and it will reinforce the support level break. Now, if you are someone who uses ATR on an intraday chart, such as in 1 minute or 5 minute or 15 minute time frame charts, then usually ATR will spike higher right after the market opens. When major exchanges like NSE and BSE opens at 9:15 am, the ATR moves up during the first minute. And that is because the open is the most volatile time of the day and the higher ATR simply indicates that the volatility is higher than it was at the previous day's close. Now after the ATR spike at the open of the day, the indicator typically spends most of the day declining. The oscillations in ATR indicator throughout the day don't provide much information except for how much the price is moving on an average each minute. In the same way, you can use a daily ATR to see how much an asset price moves in a day, while intraday traders can use 5-minute or 15-minute ATR to estimate how much the price could move in 5 or 15 minutes. This simple strategy could help establish profit targets or stop loss orders, which we will discuss next. Let's start with setting up stop loss using ATR to counter price volatility. Now let me ask you something. Are you one of those traders who is tired of getting stopped out of your trades prematurely? Now the reason for this is pretty simple. It is because you are using one of the simplest stop losses called the hard stop loss, in which you simply place a stop loss a certain number of points from your entry point. This is not a very logical method of placing a stop loss. Moreover, having a hard stop loss in a dynamic market doesn't make sense. Think about it. Why would you place a 20-point stop loss in both a quiet and volatile market? Similarly, why would you risk 80-point stop loss in both calm and volatile market conditions? Your stop loss will greatly depend on the nature of the asset that you're trading on. You can't just keep the same stop loss for a similar trade for a wild index like Bank Nifty and a more calm index like Nifty. And that's because your stop loss may be too tight for Bank Nifty because Bank Nifty is a more volatile index. So what is the solution? The simple hack is to give your trade breathing room. This means your stop loss should be wide enough to accommodate the price swings of the market. Now you might be wondering, how much is wide enough for my stop loss? Well, here's where you can use the ATR indicator to help you. ATR is an excellent tool for determining the size of a stop loss at the time of entering your trade. Because it measures the volatility, it informs you about the magnitude of stop loss that must be placed when a trade is entered. So a high ATR reading is indicative of high volatility, and it tells you that a wider stop loss must be placed to avoid getting whipsawed. Similarly, a low ATR reading is reflective of low volatility and tells you that a narrow stop loss is enough due to the lack of directional trend in the market. Actually, there are two ways in which I use ATR for setting my stop losses. The first method is very straightforward. All you have to do is to find out what the current ATR value is. Then select a multiple of ATR value. So a multiplier of anywhere between 1 to 3 is good enough. And finally, add or subtract that amount to the nearest resistance or support level from which you have taken a trade entry. So if you have taken a long trade from a support and you have a multiplier of 1, then set your stop loss 1 ATR below the lows of the support. Or if you have taken a short position from the resistance and you have a multiplier of 2, then set your stop loss 2 ATR above the highs of the resistance. You can also use this method when referencing a deep candles wick or a price pullback or retest, etc. The concept remains the same. You can tweak the value of the multiplier as you like depending on your risk taking ability. Now this is a very good method for both intraday and swing trading. But there are times when it is not practical to use a 100-point stop loss. It affects a trader's position sizing and reward to risk, especially if you are an intraday trader. Moreover, the price has to move at least 100 points to give a 1:1 reward to risk. So in such a situation, even with a multiplier of 1, the stop loss as well as the risk associated with a single trade is very high. Therefore, in such scenarios, the ATR multiplier method doesn't make much sense. That's when we have the second method, which is the ATR percentage stop loss method. As I have already mentioned, a higher ATR indicates a more volatile market, while a lower ATR value indicates a less volatile market. Now, by using a certain percentage of ATR, you can ensure your stop loss is dynamic and it changes appropriately with market conditions. For example, let's say for the first 4 weeks or first 4 days, depending upon the trading type and time frame that you follow, you notice that the average daily ATR range was around 25 to 65. In such a scenario, an intraday trader wants to use 10 to 50% of the ATR stop loss, meaning that the stop loss is placed 10 to 15% of the ATR value from the entry price. So if we take 50%, then the stop loss would be anywhere from 13 points to 33 points from your entry price. Now a swing trader might use 50% or 100% of the ATR as stop loss or follow the conventional ATR multiplier method. Let's say the daily Reliance ATR range from April 2022 to September 2022 ranges anywhere between 46 to 84. As such, a swing trader who uses 15% of ATR value would have its stop loss of 23 points to 43 points from the entry price. Now with that clear, let's learn how to use ATR to ride trends in the market. Here we will make use of the concept of volatility stop losses. I have already discussed this particular concept in my how to set a logical stop loss video. But to give you a brief context, a trailing or volatility stop loss is a way to exit a trade if the asset price moves against you, but it also enables you to move or trail the exit point if the price is moving in your favor. Because during trending markets, you will get big price moves and more profitability, and who would want to miss such an opportunity? So many intraday traders and swing traders use ATR to figure out where to put their trailing stop losses. At the time of a trade, look at the current ATR reading. The thumb rule is to multiply the ATR by 2 or 3 to determine a reasonable stop loss point. So if you are buying a stock, you might place a stop loss at a level twice or thrice the ATR value, just below the entry price. And if you are shorting a stock, you would place a stop loss at a level twice or thrice the ATR above the entry price. Now if you are long and the price moves favorably, the stop loss also continues to move twice or thrice the ATR below the price. In this long trading scenario, the stop loss only moves up and not down. Once it is moved up, it stays there until it can be moved up again or when the trade is closed as a result of the price dropping to hit the trailing stop loss level. Now the same process works for short trades, only in that case the stop loss only moves down. Now let us understand this with the help of an example. Let's say the ATR value is X. What you can do is that you can decide upon a multiple of X to trade your stop loss. Let's say, for example, you want to write trends and you don't know how much buffer space you should give to your trades. So if the stop loss is too tight, you might get stopped out on the price retracement or corrective moves. So you have to give it enough room or buffer space so that you can accommodate the retracement that comes along with it. So decide upon an ATR multiplier, which may be 2, 3, 4, 5, etc. So one example you can use is 5x, meaning a multiple of 5 as your average true range. So if your average true range value is 20, then multiply it by 5, then your trading stop loss is basically 100 points from the highs or lows depending on your trade type. Now if you are long, then subtract x times ATR from the highs and that is your trailing stop loss. And if you are short, then add x times to the ATR value from the lows and that's your trailing stop loss. But all these calculations and plotting is hard work. So to make your life easier, there is a very useful indicator called the Chandler stops which performs this function brilliantly. What it does is that the Chandler stop would take the highs and it calculates what is the ATR value, which is x. In this case, assume that I have used 5 as my multiplier, so I am using 5 times ATR for buffer. Now what the indicator will do is that it takes 5 multiplied by x and this is the level which is your trailing stop loss. So all you need to do is to hold on to your trade if the market is above this particular level, which is 5 ATR from the highs. And if the market does not break below it, you just hold on to your trades and it is as simple as that. Now this is a very simple tool that helps you ride massive trends in the market. So now you can ask me, which is the best ATR multiplier to use? The truth is, there is no best ATR multiplier. But there is the fact that the tighter your multiplier, the smaller the trend you will capture. And the larger the multiplier you are using, the longer the trend you will ride. It really depends upon your risk appetite as to how big of a multiple that you want to use. But as a rough guideline, if you are using a smaller ATR multiplier, then you will ride small trends and the time held on the trade is shorter. And if you use a bigger ATR multiplier, then you will ride bigger trends and the time held on the trade is longer. So if you use a multiple of 2 or 3, you tend to capture short-term or medium-term trends, and anything above 5 or more, you will be able to capture long-term trends. Moving on, let us now understand how to set targets using ATR indicator. Now if you don't want to ride trends, you can also use the ATR indicator to set a profit target. And here's how it works. We already know that the ATR indicator tells you how much a market can potentially move for a particular period by accounting the market volatility. So let's say Reliance has a daily ATR of 50 points. It means price could move on an average of 50 points on a day. This means if you are a day trader, you can have a target profit of 50 points give or take, and there is a good chance that it will be hit. Of course, you don't want to blindly set a 50 points target. Instead, combine it with market structure or areas of values like support and resistances, swing highs, swing lows, etc. so that you know where the price might reach for that day. My point is that entries and exits should not be based on ATR indicator alone. ATR is just a tool that should be used in conjunction with an existing strategy to help filter trades. Only if a valid buy or sell signal occurs based on your particular strategy should the ATR indicator help confirm the trade targets. Now let's consider another example. Let's say Nifty moves an average of 100 points a day. You went long at the support level based on a reversal strategy and you are not sure where to take profits. There are 3 possible resistance levels which you can possibly achieve your target. First is 30 points away, the second is 60 points away, and the last level is 150 points away. Which resistance level would you choose for your targets? The 30 points target is likely to hit within the day, but you are leaving a lot of money on the table as the market could move up 100 points a day on average, given there was no big news or event to trigger a gap up. While the 150 points target is unlikely to be hit within a day as it's more than the ATR value. So the 60 point target is your best option as it is within the daily ATR value and offers more profitability than 30 points level. So here's the takeaway when using ATR indicator for determining your targets. The first step is to identify the daily ATR value. And secondly, when you set your profit target, combine it with market structures, areas of values, and ensure this target distance is less than the daily ATR value. And if you are a swing trader, you can refer to the weekly or monthly ATR value for determining suitable target levels. Now let us learn a breakout technique using ATR to identify strong and explosive breakouts. As you may know, markets are always changing. It moves from a period of low volatility to a period of high volatility. Then it moves back from a period of high volatility back to a period of low volatility. It is like a cycle that repeats over and over again. This is typically how the market moves. I have explained this in my market structure video. So if you have noted, when the market is in a low volatility environment, there is a good chance that the volatility could expand in the near future, giving powerful price moves. So how do you use this knowledge to find explosive breakouts using ATR before it actually happens? Before we get into it, let me make it clear that this particular strategy works well on longer time frame ATRs, mostly on daily, weekly, and also the monthly time frames. You will understand the reason why in a little while. Basically, the idea is to pay attention to the ATR value, especially the multi-year low ATR values. Notice if the ATR value has slumped into multi-year lows. This pretty much indicates that the market is probably in a range and the volatility is shrinking to the absolute lows. So when the market finally breaks out, it comes with an expansion in volatility which is associated with strong price moves towards either the upside or the downside. Now, the reason why this method is not particularly reliable in lower time frames, ATR values swings every day from highs to lows, which is not really indicative that the market is range bound. It just means that the market volatility is declining. But when we consider ATR of much higher time frames like weekly or monthly, and if the values are coming out very low in terms of a few months or years, then there is a good chance that the market could potentially be in a range, and thereby you could get a highly profitable trade on the direction of the breakout from the range. So just look at this example of Zeal stock. On a weekly time frame, whenever the stock reaches multi-year lows on the ATR value, the stock is expected to give a good price move in either direction, which is indicative of high volatility breakout trade. Swing traders and positional traders can capitalize on these volatility shifts to make much better trading decisions. So all you have to do is to check if the market is in a range, see if the volatility is low as represented by ATR, then wait until the market breaks out or breaks down, which indicates the volatility is picking up. Then plan your trades accordingly when the breakout of the range happens. So whenever the volatility is low, especially when it is approaching multi-year lows, you want to tell yourself that if the market does a breakout, a big price move could follow, and this is a very powerful trading technique. Now finally, let us learn how to use ATR to predict market reversals or price exhaustions. See, the market can't move up or fall down forever without exhaustion. Most of the time, the market will need a break to recharge, just like we human beings do. This means there is a good possibility that the market could exhaust itself after hitting its limits. Now you might be thinking, how to tell where is the limit? Well, you can find that out using the average true range indicator. Now here's how you can do it. First of all, identify the current ATR value and then multiply it by 2 or 3. So if the market moves 2 times the ATR value, then it could possibly be exhausted. Now, I don't suggest you trade this concept in isolation. Instead, combine it with support and resistances or other areas of values, and then there is a high chance that you'll find yourself identifying market reversals ahead of anyone else. For example, if you look at the weekly ATR value and it shows you 300 points, what it's telling you based on the previous period's data is that the market tends to move about 300 points over the last few weeks. And if in this week the market has moved, let's say 500 or 600 points, it's telling you that the price has already exhausted its ATR value. Think of it like energy being used and the market is exhausted. So if you see a market that has exceeded its ATR value by 2 or 3 times, then there's a high possibility that the market could show signs of reversals. So if the weekly time frame has about 300 points on its weekly ATR, and the market has already declined more than 500 points lower, And I'm not asking you to go long suddenly in the anticipation of a bullish reversal, because the market could even stay in a range for a while. But think of this as a signal to alert you that this market has already moved more than 500 points in comparison to its weekly ATR value, which was only about 300 points. Now you have to look for evidence that supports your analysis of the possibility of the market actually reversing back higher. So you can look for potential area of values like support levels, dynamic supports like moving averages, where potential buying pressure could step in. You can also take the help of bullish reversal candlesticks like bullish engulfing patterns, rejection pin bars like hammers, etc. Or you can use a combination of both these setups to support your analysis. Now this should give you a hint that you don't want to be shorting in the market anymore. And if you are in a short position, you might want to exit out of the trade by booking profits or losses, whatever. Then you can get onto a long position in the anticipation that the market is about to reverse higher. Now this is how you can use the ATR indicator by basically looking at how much the market has exceeded its actual ATR value. You can use this method even in lower time frames, but as always, it works best with higher time periods. Now that is all I have for you on this simple yet powerful indicator. Make sure you backtest all that you have learned, because that is the only way you can improve as a trader. And if you have learned something important today, please make sure to like and share this video. Don't forget to subscribe to the channel and enable the bell icon so that you won't miss out on any upcoming videos. I will see you guys with another video. Till then, see you.